At some point, we'll go back to much more normal rates, real rates in the 2 to 3% range, and that's going to make equities less attractive.
Should we worry about a stock market bubble? Harvard's Martin Feldstein is. He joins me now. Good to talk to you.
Nice to talk with you.
So we've seen the market actually stagnate as of late, but you're worried that we're a little ahead of ourselves. Why?
Well, interest rates are very, very low. And those extremely low long-term interest rates, real rates very close to zero on treasuries, on tips, are forcing people to look elsewhere to try to get some yield. And they're turning to the stock market. But those interest rates are likely to rise. So we've got a bubble in the long-term bond market. At some point, we'll go back to much more normal rates, real rates in the 2 to 3% range, and that's going to make equities less attractive. The other thing is that business profits, have been good in the past year. They're slowing down now. We're seeing some negative news on profits. But a lot of those good profits were coming from overseas earnings, and they were coming from the fact that the U.S. dollar was falling, so that when you translated euro profits into dollar profits, they looked better. Well, all of that has stopped happening.
What if the economy starts improving? Does that take away that possible bubble?
It may make it worse, because if the economy starts improving, we may see long-term rates rising. Long-term rates are down because the Fed has promised to keep short rates down for the next few years. Those few years will start to become shorter and shorter in terms of perspective, and the Fed may show a willingness to let rates rise. So I don't think that an improving economy per se is going to help the stock market. It certainly won't help the bond market.
Well, bubbles never end well, as we know, and are often detrimental to the economy. If we do see a bubble burst in either stocks or bonds, can that further thwart the very slow recovery we're having?
Yes, it would. I mean, most people are still looking at wealth which is lower than it was before the downturn began 5 years ago. But those who are stock market investors are ahead of the game, and that's helping to keep high-end consumer spending going. That could turn around if we saw a decline in the stock market.
I think the burden of proof is on Mr. Diamond to show why he shouldn't be required to do some givebacks. Not that he's going to notice it at the level he's compensated.